Right. So good morning, everybody. We want to, today we'll carry on with this financial ratios, the fundamental analysis. But maybe before we go and discuss, we carry on with the liquidity ratios, solvency ratios, and the investment ratios. I want to give you a very kind of snapshot of what has happened to Credit Suisse in the last couple of days. As I mentioned before, that apparently there is a 54 billion at stake, which have been lost. Actually, they're not even at stake. They have been lost in the stock market. And the reason is exactly these three ratios that we shall study today. What happened? Exactly the same thing. You know what? That's the thing I sometimes wonder, that we say that the history repeats itself, but we never learn from it. Exactly the same thing happened in 2006 and 7, before the major financial crisis struck the world. And what happened then and now? The financial institutions, they are in conflict. They are competing against each other because they want to please their shareholders. And to please their shareholders, they need a lot of money, a lot of earnings they want. To earn a lot of money, they start giving loans to the companies and the individuals. Now, the problem is that if you have a good check, if you are a banking organization, and there's a customer coming to you, and this customer, this company says, which is a multinational company, it asks you, I want to borrow money from you. I want 20 million, let's say, the loan, which I want, if you can sanction me. Now, what happened is that if you follow all the disclosure, all the due diligence, all the rules and all the principles, maybe your customer can be annoyed and he can or she can go to the next door bank. So if HSBC is saying, no, I have to follow some strict investigation, your credit check, all the things, whether you can pay or not, then this client could go to Royal Bank of Scotland. And because nowadays the companies can also shop loans, like you can do the shopping of buying a fleece, you can also do the window shopping of loans. And you get the loan where the interest rate is the lowest and where the repayment period is very lenient and where you have to give the minimum of disclosures. These look very customer friendly, but then there can be a problem. It's not very good. And what happened is that the banks, they say, all right, if we follow two strict principles and rules and regulations, then our customer, the person, the company who's borrowing from the bank, they can go elsewhere. No, it means like losing a client. So what they do, they actually make those rules. And first of all, these bank managers ask you to comply with the rules, but then they also guide you how to dodge the rules. I have been a witness many times that I've been in touch with some top officials of banking organizations. If you talk to them in a more professional way, it will look that these people are following these rules and regulations very strictly. But when you talk to them privately, and then they say, these are just statutory things. Things can be bent this way or that way, and something. So we can facilitate the companies who want to borrow from us. So what happened? The rules, regulations basically were not followed in sanctioning the loans. And then what happened? The companies which got the loan, they found problem in repaying these. Or some of the companies even got bust. Now the thing is that, what should you do then? If you are a bank manager and the companies or the individuals who have taken loan from you, how do you ensure that even if they have any financial problem, but your stakes are safe? What would you do if you are a bank manager? If I'm a company, if I'm a potential borrower and you are a bank executive and I come to you and I ask you, hey, I want to take loan from you, you will not simply give money to me. What would you do then? what would be the first couple of things which you would do to sanction me loan? Hello, hello, hello. Yeah, nothing? You'll just give me loan? Oh, I wish I had such generous bankers. I simply go, I ask them, can I have $25 million? And you say, all right, Shab, don't worry. You just have to wait for a few minutes, okay? And we will give you 25 million. What would you do? Hmm? Nothing? If you're offered a job of a bank manager and a client comes to you and the client says, can I borrow this X amount of money from you? Would you just give it? Or what would you do? I mean, I just want to, yeah. Very good. First of all, they would check that do I have regular income that I can pay the mortgage and the interest on top of that. So it means, do I have the regular income? If two people go to the bank, one is salaried, the other is unemployed, all else being equal, the bank would give loan to the salaried person because the cash flow of the salaried borrower is more stable than the other guy. What else would you do? It's all based on common sense. What else would you do? Mm-hmm. You will check the history of this company. Have they defaulted in the past? Have they defaulted in the past? If somebody has a very shady history in terms of repayment of loan, the bank should never give loan to this person because he would do the same thing again. I mean, this company is like having a track record, bad, poor credit history. What else would you do? Any third thing you'll do? You'll ask them that, hey, do you have any fixed assets? Do you have a land, property, building, something? You have to use it as a collateral. The word is collateral. I don't know if you heard it or not, but if you haven't, I can do it now. Collateral. You can also, in simple word, you can also call it some security or a pledge, whatever. These are the things which you can deposit. Normally in Finland and in many other countries, if you buy a house, you take the house on loan, and you buy the house, you pay some down payment, and then the banks come as a guarantor, as a loan provider. You buy the house, the house papers come to you, but at the same time, the bank take away those papers from you and keep it in its own possession. Why so? Unless you pay the last cent of your loan, those papers would be in the custody of bank. Why? Because if you are unable to pay back loan, the bank has a security. The bank can sell those assets and recover their loan. That is the whole idea. Once you make your last mortgage installment plus interest, you get your papers. Now it's done. But why I'm saying all these things is that because of the demand pressure, because there's a recession in the market, the banks are stashed with money. Banks don't know what to do with the money. It's like you have too much of inventory in your warehouse, but the customers are not coming to you. What would you do then? You'll try to put some placards outside your shop, sale 20%, sale 40%. Now the banks can't do it, but what banks can do it that they can make your loan process simpler, or rather they can violate the rules. They can say, all right, normally your credit repayment is 10 years. Okay, we extend for 20 years. You have to fill this paper, this paper, this paper. We ignore it. We assume that everything is fine. If you want to take 1 million loan, there should be a property used as a collateral, minimum 1 million value. Okay, we make it $500,000. So now the banks are using those, they are flouting, they're violating the rules by themselves. Why? Because they want to outcompete their competitors in the banking industry. You get my point? Are you understanding what I'm speaking or not? Okay. Now, what happened that if one or a few of your customers become bankrupt, will it happen? Will it affect you? Well, they will not be able to repay the loan. The collateral they gave is either absent or very low value. And when this news become public, so it means that if you, the word is solvency, if you are giving too much of loan and stuff without violating, this news become public, then the stock price will go down because the market would react negatively. And here I'm saying is that 54 billion of investors in Credit Suisse has been evaporated, eliminated, just because of their bad solvency. Okay, let me show you where the solvency thing is. Goodness me, where it is. Stop share. Share again. Okay, because they followed some of the bad investment ratios, the solvency ratios as a, so the problem started from here actually. This is the cause of problems. In few days, $54 billion have been lost because of the bad solvency ratios. This affected the investment ratios. This affected the investment ratios. Okay, now these banks which were claiming that they are flooded with the money, now those banks are getting moneyless, so much so that they are able to, they are finding themselves very uncomfortable in even meeting their day-on-day basis. So they have very poor liquidity ratios. So the story starts, you give too much of loan without any rules, it means solvency, a problem. A fact, the stock price goes down, means investment ratios are bad. Now how to run the show, how to survive? You have to show to the outside world that you have a lot of money to operate. It means then you need to build up your liquidity ratio. So this is a typical case. Nothing has changed. The same kind of crisis, the same kind of scandal used to happen some 100 years ago. Little bit of nature changed, and they are still happening now. So what have we learned from the history? Nothing, basically. This is what used to happen in the past. So nothing new has happened. Not long ago, 2007, this US subprime lending housing market, the banks were throwing money. I mean, if you are in the US and you want to buy a house, just go to the bank and the bank would, they would feed you with a lot of money. Go and buy a house without checking who you are and things like that. The same thing is happening. So that is why it came to my mind that today, when we discuss this topic of ratios, first, the cause is solvency ratio. The effect is the bad investment ratios, and the solution is increase the liquidity ratios. I will not discuss these things exactly in the order, because first we shall discuss liquidity, then solvency, and then investment. But now you see the solution, and now you see the problem, is that bad solvency ratio caused Credit Suisse and the other banks in a very bad shape. The impact is that a lot of money has disappeared. It means the investment ratio became very bad. And now they're trying not a proper solution, but like a temporary solution they're finding is through the liquidity ratio. So that's why we have a context of studying this topic today. Yeah. Okay. All good? Any question? Any comments? And remember one thing, this happened to such a mega multinational bank. Hundreds and thousands of startups and the small and medium enterprises, they have to go through this problem on day-on basis. And nobody talks about them because they're too small to discuss. They are not even noticed. We notice only the big companies. We notice only the big mega multinationals. So just imagine such resourceful company, which has its presence almost in every country in the world. So many alliances, so many partners, so many collaborations, so many joint ventures. This company is now in deep crisis. Just imagine some small and medium enterprises. Things would become horrible, but we don't know about them. You see my point? So we are living in the age of information, but we don't have the information about hundreds and thousands of the companies which become bankrupt just because of these problems. And they people, look at their management, look at the guys who make decisions. Take the best school of finance in the world. They come from those schools. And they still make those silly, these kindergarten kids type of mistakes. They do it. Yeah. So the first set of, I think the last week, you discussed about the operating ratios, maybe in the context of your case company. So we take the liquidity ratio. The liquidity ratio is a measure of company's ability to cover up its expenses on more regular basis. You might be having a big house, but you may not have enough money to pay for its repairs or pay the utility bills. It means you have a lot of investment, your assets are very high valued, but your liquidity is very bad. So the liquidity is your immediate paying capacity. Can you run the show? Can you run your company on day in, day out basis? If you can, then it means you are a very liquid company. Usually the companies with the cash flow come very regularly are more liquid, and where there is a long gap between the transaction and the payment, they are less liquid. I mean, if you see the companies like any retail store, for instance, or the airline companies, you see that you pay and then you get the service or the product, right? So the payment is so instantaneous. Transaction, the gap between transaction occurrence and its payment is very minimal. You go to Prisma, you go to some store, you take the products, you're at the till point, you make the payment, you take the products with you. So almost no gap between transaction and the payment. Okay, it means that all else being equal, the companies like Tesco, Walmart, Prisma, Lidl, they all would be having good liquidity ratio. But if you're a mining company, if you are an oil exploration company, construction firm, okay, heavy engineering, like let's take in the same, let's talk about Walmart. Very unlikely that people buy the product from Walmart and make the payment on the till point. Kone, people buy some lifts, some elevators, okay, don't carry to the till point, but take the invoice and make the payment at the till point, impossible. It might take months and years sometimes. So the gap is low, the gap is massive between the transaction and the payment, all right? So normally B2C type of products, if they are not high valued, they're low valued, more frequently used products, we use a phrase called FMCG, fast moving consumer goods. FMCG, fast moving consumer goods, all else being equal, they should have very high liquidity ratio because customer pay and then take home the product. All right. So the whole idea is that the liquidity ratio enables you that your cash flow is regular and you are able to make payments in time. Okay. But if, for instance, your customer on an average take 5 or 6 months before they pay you, but you can't ask your employees to wait for 5 and 6 months to get the salary. You have to pay them, right? So therefore, you must be having enough liquidity in your bank that you are able to pay them. Yeah. Similarly, if you have to pay utilities, bill, rent, and all that stuff, so have enough money. The first measure is called current ratio. The current ratio is the total current assets divided by total current liabilities. The current assets and the current liabilities, both you find in which place? In the balance sheet. The current assets and the current liabilities. The rule of thumb is that this ratio should be 2:1. So at any point of time, the current assets should be more than double than the liabilities. I don't believe in it. As long as you have a historic record that you are keeping good level, consistent, stable, or if it is showing an increase, it's okay. I don't know whether you saw it or not. If I can quickly show you the BP. Let me see if I can quickly retrieve it. In the study material, there should be spreadsheets and then BP2. Here we go. Sorry, it's just taking a bit to open it, but it will. Yeah. So liquidity ratio. Is it visible on Zoom, or should I double check? Can somebody confirm that?
Yes, sir. Yes, sir.
Spreadsheet. Just drop a word in chat. So you can see that the British Petroleum, the current ratio is not 2:1. Okay, but I'm not surprised why it's not 2:1. Because for the British Petroleum, most of the transactions, the bulk of revenue come from B2B transactions, where the repayment can take sometimes years. So even this ratio is less than 2, but I'm not scared of it unless it goes very down. I mean, if this in the future, if the graph is going down like this and it's below 1, I will be worried. So for example, not a very good situation in 2007, well, and not a good situation in 2019. So we know the reasons why. Okay, but in between 2011 until 2014 was a time when I would say the BP's liquidity ratio was showing a very promising increase, despite the fact that it has never been 2. It's never been 2, but I'm not worried. If I'm a CFO of this company, this 2:1 ratio, I don't care. But this, if you look at the textbooks, they would always say the ratio has to be 2:1, but we don't care about it. But I would say that if it goes down consistently, regularly, and so much so that it becomes less than 1, regardless of the company you are, your nature, your industry, sector, you have a reason to be worried, okay? Because if this liquidity crisis keeps adding up, it would affect your solvency also. If you can't make your monthly payment, weekly payment, then this will accumulate and eventually it would show on your overall solvency. Okay, so that is why my whole idea of showing this spreadsheet was that 2:1 is a good measure, a rule of a thumb, but it's not a kind of writing on the wall. It's not a final verdict. As long as it's a stable ratio, but definitely more than one. Stable ratio, more than one, showing sometime milder increase. You guys are doing great job then, okay? So that was the whole idea. Sector, some sectors are more cash fetching, some are slow, so that can vary. As long as you are taking care of, you're keeping the proper radar, monitoring it on almost everyday basis, it's okay. And I would say that these ratios are liquidity ratios. They are largely monitored and supervised by the corporate treasurer, sorry, it's a tongue twister, treasurer than the CFO, okay? It's a job of the treasury to take care of it. CFO is informed about it, but how this money is coming in, money is going out, at what pace, how much is the gap, which month you should be more careful when people don't pay you. Is it post-Christmas? Is it a February effect or a March effect? What about November? Are people buying in November or they keeping money safe for December? You know, that's all these things. So how to manage these difficult months? This is a job of corporate treasurer than the CFO, okay? Yeah, this is fine. This is just the thing. As long as this ratio is consistent, I don't care. Look, even though, yeah, so the ratio is going down. It has never been 2, but 2005 is consistent, is a good information, but then it's going down. What if the current ratio increases beyond the normal range? There can be good reasons, there can be bad reasons. The good reason is that you are building up your current assets, and largely they are coming from the inventory. You have done a lot of advertisement because you're launching some new product or new service. Now, you know that if your campaign becomes successful, there'll be lots of demand. And if there's lots of demand, you have to produce more goods and services. Do you have enough inventory in your warehouse that you can meet the customer's requirements? So then what happens? You start buying lots of inventory. And inventory is a part of which kind of assets? Current assets. It means given the current liabilities, the current assets goes up and the ratio start looking good. Another reason could be that you want to have a permanent expansion of the business, which will require the use of usually because of the more inventory, the customers, the companies start looking at building up the more inventory stock because they know that they have to meet up the customer's expectation. If you're living, and sometimes the macroeconomic variables play a big role. If you are living in an era in which the market is going down, you know that there is a recession going on. In that case, you will stop building up inventory stocks because you have already so much of stock lying in your warehouse. So then what happens? Then suddenly your liquidity ratio goes down because you have less inventory than before. You see, remember the last set of ratios we did, operating ratios, and remember there was this inventory turnover ratio, how fast you can modify, convert the inventory to the final product. So all these things are interconnected. There can be some bad reasons also. The bad reason is that the operating losses have reduced your working capital, which is the gap between the current assets and the current liabilities. So as a result, the company can even think of selling the assets. Look, this is so I think we discussed about it, but it's not a bad idea to discuss again. Imagine the company is having losses, profits are declining, they're having losses. When they have a loss, it means you have less cash. Question is how to camouflage this loss and disappearing money that the investors and the financial media doesn't notice you. You go to the bank says, no, we can't give you loan, you are a sinking ship. What this company can do then? The company can sell its assets and get the cash. And when people like me, you, we look at their income statement, the balance sheet, it shows that the current assets are quite promising. But we don't know the source of this rising current assets. So this can be like you are in a war and you're selling your ammunition to the enemy, basically. So it's like that type of situation that when the company doesn't have assets, how would you work? You cease to exist. When a company starts selling its assets, I know if the assets are old, you want to decommission them, you have lots of aircrafts which have expired maybe 2 or 3 years. Okay, fine, I understand. But if you are selling your assets out of distress because you can't sell goods to customer, you can't get money from the customer, so what you do, you start selling your assets. It's a bad reason. Now, when you do this thing, start selling assets, you can't discover from your current ratio. Then you have to do the qualitative analysis. And how do you do the qualitative analysis? If you look at your financial statements, there are explanatory notes, okay? Go click them, see where this cash is coming from. Or if you have some 500-page long annual report, use the keywords. Just say assets, cash. So put some keywords and start knowing where their cash is coming from. Is it that the good reason of cash coming in is sell goods to customer, they pay you, great. The bad reason of cash coming in is you start selling your assets. Okay, so you need to know the color of the money is very important. The value of the money is same, but you need to know where it comes from. What is the source of money? So there are some bad reasons. Inventory. Okay, sometimes what happens is that your current ratio is exceptionally high, maybe 3, 4, 5. You know why? Because your inventory, which you bought 10 years ago, is obsolete today. It's out of fashion. It's a dead weight. But because it still shows in your records, it shows that your current assets are high. So what happened is that, imagine a situation, your current asset, the current ratio is, let's say, 3 or 4, right? But the main reason of this ratio being high is very high inventory value. And even worse, most of this inventory is old-fashioned, obsolete, which will be not used in the factory anymore. Your machines will stop functioning. You got new machinery now. That new machinery cannot process this old raw material. Throw it away, get rid of it. But if you do it, then your current ratio will go down. And then the investors start asking you questions. So sometimes managers, now you have to be very careful about the intentions of the managers, the top executives. They are in a catch-22 situation. If they throw this inventory away, their current ratio will go down. And then in the board meeting, the directors will ask, hey, why your current ratio is going down? Are you not able to sell goods to customers? Why it was so high last year or the previous years? And then you confess, you know what, we had a lot of inventory. That is why our current ratios are looking very good. Well, the board of directors will not be very pleased to hear this. So sometimes you don't want them to know. So you keep building up, you keep continuing, sticking with those obsolete inventory, which you also know is a dead weight, will never be used. I'm coming on that. Okay. The second ratio, which exactly is the question you asked. Look, only you guys can know it because you study it, so you think it more conceptually, right? But still, many people, many investors, the many individual investors who don't have any financial background, they take this ratio, believe me, very seriously, very seriously. But they don't know that they have a much better refined ratio called acid test ratio or called quick ratio. The beauty of the quick ratio or the acid test ratio is that it still is current assets divided by the current liabilities, but minus inventories. Inventories are something which the managers can manipulate with, the management can tweak to hide the truth of the company. So this ratio is current assets take away the inventories and then divide by the current liabilities. And there is a reasoning, not just the managerial intentions, not just that the managers they have some hidden agenda, but even conceptually, inventories are a bit dodgy, a bit different. How? By definition, the current assets are those assets which can be converted to cash or cash equivalents very fast, in no time. But imagine you have inventory and you want some cash. Would you organize a sales, a special campaign? How would you convey people that we have inventory, come and buy? And why I would buy from you? If we are in the same business, why should I buy inventory from you when I go to some shop and buy from? With better quality, with better contract, and so on and so forth. So therefore, the accountants, they sometimes ask you that you also, not just the current ratios, but also show your quick ratio, which is current assets except for inventories. Okay. Again, there are some benchmarks, some legends. The legend is 1:1. Again, I don't believe in it. You can ask me, Shab, if you don't believe in it, why you have it? Because I'm thinking like a researcher, but the books are the books. They have some overly theoretical argument. Many textbooks, when you read, they would say that it should be 1 or above, but it doesn't matter. It depends upon industry and the sector where you are in, okay? And then the purest form of the current ratio is called cash ratio, only cash. Look at the cash. Forget about the bills, forget about the stocks, forget about the inventory. Only look how much cash the company has. But again, the problem is that if you are only focused on cash, you can never know, is this cash coming from some bad reasons like selling of assets and so on, okay? So that way, accountants still have a leeway to tweak the data, okay? So when you are a financial analyst, when you are a fundamental financial analyst, then when you are going through your company's financial statements, please help yourself, go to the explanatory notes, okay? I'll tell you something, when you finish this assignment, and when you finally have this spreadsheet where you have those graphics, I will tell you one thing. If you notice some very weird change in the graph, then I would recommend you go to that year's annual report and check the explanatory notes. What happened so good or so bad that year only that the graph suddenly became so either so good or so bad. So after you have your last leg of this assignment, when you draw those graphics, report is written, and if you see something unusual, then go to that year's annual report and check out what could be the potential reason. And the reason you will only know. Check this ratio, this numerator, this denominator. Check the explanatory notes in the report and find out if some unusual things have happened. Right. This ratio is nothing. I mean, it's fine. It's okay. The working capital is the gap between the current assets and the current liabilities divided by total liabilities. The reasoning, the explanation, everything is same, which we discussed. So it'll be kind of repetitive if I discuss it. Let's take a short pause. Now you have idea what is the, and this is what now, because I thought maybe this is not so important, but now I realize it was important. So I repeat my words. I said, always, maybe I'm too far-fetching when I'm saying always, but majority of the times, there is always a corporate scandal behind the corporate bankruptcy. And behind every corporate scandal, there is some financial data manipulation. Either you are showing the goody-goody things too much, you inflate your success, you exaggerate your success, or you are hiding some uncomfortable facts. It works for some time, it works for the short period, but this heaps of lies cannot sustain. Eventually, the bubble burst and the company becomes bankrupt. But in the process, the investors and the stakeholders lose tons of money and a lot of other social psychological problems also. When this Enron became bankrupt, I think I discussed many times with you, but it's such a classic case that I can discuss as many times as it's possible. Enron, this energy production and energy distribution company in the US, was in the 4th or 5th slot in the list of Forbes 500 successful companies. And the parameter of success was the profitability and also the, responsibility, the corporate responsibility. And this company, Enron, was always among the top 5 in both cases, profitability as well as the ethical conduct. In fact, the year before its bankruptcy in 2001, it got some best rewarded or the most ethical company of the year award as well. But what they were doing? They were, first of all, these goody-goody things. They were creating fake invoices. They were also selling, because this company, this was the flagship company, Enron, and this company created about 1,000 fictitious private companies. So Enron created 1,000 something fake private companies. And then this Enron was selling the goods to those fake companies. When you sell, what happens? Your total revenue goes up. Since the cost remains same, the gap between the revenue and cost becomes larger, which is called profit. Number 2, Enron started borrowing, not directly, but in the name of these small private companies. In other words, Enron was borrowing millions and hundreds of millions of dollars, but it was not showing anywhere. It was not showing in Enron's balance sheet. What do you call it? On the liability side, the finance debt. So the finance debt or the interest-bearing liabilities of Enron, the consolidated statement, it was not showing anything because Enron was borrowing against those fake private entities. They're called SPE. They're called special purpose entity. Special purpose entity. And you know why the companies create special purpose entities? They want to have a group of some specialists. For example, they can create some entity. Hey, we have CFO, we have our accounts managers, but let's hire some top financial experts, some top MBAs in finance, and let's create the group. They will not be part of the company. They will not be part of the company, but whenever the company needs some out of the box kind of way of thinking, which our CFO is unable to see, our other accounts managers are unable to see, we can approach those group of people. It's like a think tank, financial think tank, special purpose entity, let's say about finance. And then those SPE were borrowing lots of money. Not they were borrowing, but Enron borrowed through them. And then eventually what happened? As I said, this heap of lies keeps bulging up. But how long? Eventually, it became burst. I tell you something, it took only a week and a half when the share prices of Enron went down. $70 something at that time was very high price of a share. In a few days' time, it becomes worthless, zero. The company disappeared. Why psychological effect? Because even the employees' pension fund were also wasted by the company. So the company, Enron, even spent the employees' pension funds, and thousands of employees became bankrupt. They became out of job. And when you are unemployed, this will also have so many psychological impact also. And it's not a very pleasant thing to be unemployed. And guess what? In this whole debate, when you start doing something crooked things, you don't do alone. There's always somebody, a partner in the crime. And this time with Enron was a company, it was an auditing company, which is no more existing. The name of the company was Arthur Andersen. Arthur Andersen was the company which was doing auditing services for Enron. And this company was exactly doing the same thing, that their job was to keep a check on the authenticity of the financial statements of the company Enron, but in turn, they were guiding Enron how to cheat. You see my point? It's like a cop telling you how to commit a crime or how to do a robbery and not get caught. If you find some very corrupt cop and ask him, okay, take some money from me, tell me who is the wealthiest person in the city, I want to steal money from him. And at the same time, also not get caught. And if they're doing it, if they're telling you how to do it, then this is what exactly Arthur Andersen did. And when, after a few days of Enron's bankruptcy, people came to know that Arthur Andersen was actually hand in glove with Enron to do this scandal. Arthur Andersen also failed. And there were about 68,000 or 70,000 employees of this company all over the world. They also became bankrupt, not just Enron. So the other companies also, when the bushfire happens, it doesn't remain in the region where the fire starts. It burns the whole forest. And that is what happened with this. And now when you see this Credit Suisse, this thing is happening, I hope it doesn't go that bad, but things look very scary at the moment. Yeah. We can have a 5 minutes break and then we continue, okay? So see you in 5 minutes. No, I started now. Now can you keep track? Just a sec. There's nothing in the discussion, no chat, nothing. Or Zoom friends, or before we go and take a plunge in the solvency ratios, it's a good idea to have a recap of liquidity ratios. A company is said to be liquid if its current assets are more than its current liabilities. On the other hand, a company is said to be solvent if its total assets, total means the current plus non-current, are more than its total liabilities, which means the current and non-current liabilities. Then a company is said to be solvent. But if it happens that the company's total liabilities are more than total assets, then the company is called insolvent, which means the company is now out of business. It's bust. It doesn't exist. Okay, unless there is a very big restructuring, the company cannot come back to its So basically, it is the overall financial health of the company and its viability and its longevity, sustainability, whatever you call it. It depends upon the solvency ratio. When a company is insolvent, then no matter how good other ratios are, it doesn't matter. So all other ratios, all other good-looking ratios become redundant if a company is insolvent. So therefore, this is the most important ratio. And as you see that the root cause, whenever we say, hey, you know what, this company became bankrupt, the one parameter of bankruptcy is that its assets are lower than its liabilities. So when I say assets, mean total assets, total liabilities. So at some stage, when the company's total liabilities are more than total assets, then the company ceases to exist, and it's called insolvency. Okay, so, and this equation is very important because the total assets, if you look, are always equal to the total shareholders' equity plus the total liabilities. Solvent, total assets more than total liabilities, so the equity is positive. Remember that total equity is the balancing figure. If assets are 100, liabilities are 70, then 30 is the equity. But just imagine, the assets are 100 and liabilities are 130. It means the equity is minus 30, means it's over. The game is over. The shareholders have lost everything, basically. So that is why the shareholders are the one who burn their fingers with this bankruptcy or insolvency. The first ratio of solvency is called total debt ratio, which is equal to total assets minus total equity. So basically, total assets minus total equity means total liabilities. So technically, this part is total liabilities minus, divide by total assets. Okay. And if this ratio comes to be 0.5, just imagine 0.5. It means that for every $1 of investment, the company owes to the outsiders 50 cents. So this shows that how much the company is owing to the outsiders. Because the numerator is, I could have easily written it total liabilities here as well, because total assets minus equity are equal to liabilities. If you look at this equation, assets minus liability would be equal to equity. So if I just shuffle them, okay? So a company tries its best that this ratio is as suppressed as possible, but that's a very myopic way of thinking. That's a very old-fashioned way of thinking. If you have a reason to grow, if you are foreseeing a very promising future, it's not a bad idea to borrow. How can you, I haven't seen any company in the world which became successful without any borrowings. You have to borrow. You have to take, debt. You have to, owe resources to others. So, but if I think in a very static situation, then if this ratio is getting bigger and bigger and bigger, it can pose a threat to the company in the future. So And here, the job is not just in the hands of treasurer. Now it goes to the more senior level, to the CFO level things. So because they have to make sure that you, okay, all right, even if this ratio is very high, but consistently high, it's not showing very abrupt jumps, then it's fine, it's okay. But if it is showing fluctuations, that is a cause. You know, like the blood pressures. Some people by nature have high blood pressure, okay? But if that high blood pressure is consistent, it's not threat. It's not, doctors don't call it a threat. But if it is higher, but inconsistently higher, that's the problem. So similarly, if a company's total debt ratio is higher, but consistently higher, it's not a problem. It means the company's fundamentals are strong enough to absorb this high ratio. But if it's in zigzags, that's the problem. The second ratio is debt to equity ratio. And in the empirical research, this is the ratio that we use quite often. One thing I forgot to mention, that these debt ratios that we are discussing now, there's one more word for it. I want to share that word. Any idea what word could be? These are also called leverage ratios. Debt, in the financial vocabulary, debt and leverage are pretty much synonyms, you know. So you can say that the company's borrowing has gone up, debt has gone up. You can also say the company's leverage has also gone up. Okay, leverage has a different meaning in the normal connotation. If you have some niche, some, you know, you can, but here in this context, leverage means debt. Okay. Debt to equity ratio, how much debt you have. And debt, by the way, include both current and the non-current financial debt, okay? Remember, debt, I think I've said many times, debt is a liability, but not every liability a debt. You see my point? Debt is a liability, but not every liability a debt. Just have a look at, whenever you get some time, look at your liability side of the balance sheet. Not everything is a debt, but debt is a liability. Okay, so you need to be very careful. So this debt to equity ratio, if this debt to equity ratio is, let's say 0.75, it means that for every $1 invested by the shareholders, for every $1 invested by the shareholders, the company has also taken a borrowing from individuals or the banks or the other companies equal to 75 cents. So that shows the balance between the debt to equity ratios. The lenders observe it a lot. Imagine I'm a bank and I have given lots of loan to this company X. My job is not over when I give the loan. I can't I can't wash off my hands as a banker. I keep tracking of the companies who I gave money. What is their debt to equity ratio? And just imagine if this company is X and I notice that, you know what, suddenly the company's debt to equity ratio has gone up. I have a reason to be worried, because if this company keeps borrowing endlessly, then the problem is that this company can become bankrupt. How would I get my money back? It's so difficult for me. You see my point? So as a banker, when you are a banker, your job is not over when you have sanctioned the loan. Even if you have the collateral or whatever, you still keep tracking if this company is borrowing more. Tell me something. If you are a banker, now please think like a top manager of a bank. If you are a top manager of a bank and I come as a potential lender, okay, I give you collateral, everything, What last word of advice you will give me when I leave the meeting? Can I just borrow as much as from other bank? If you're a Nordea bank, okay, you give me some X amount. Is it possible that I can also go to OP or Handelsbank next year, 2 years later, or whatever? Will it affect you? You see my point? As a banker of Nordea, will your stakes be unfavorably affected if I keep any amount from any bank in the world or not? I repeat my question. You are a manager of Nordea and you have given me loan. My next question is that after getting this loan from you, can I borrow any amount from any bank anywhere in the world? Does it affect you? Does it affect Nordea, or are you okay with whatever I do? Mm-hmm.
And then go to next bank and want to borrow it again. They like alarm they can tell me that so you have another loan, you have to pay like this amount. The rest of your salary will not cover the payment, so we will not to pay you.
Yeah. So it means that as a banker of Nordea, you would not like to meet. I mean, of course, I can borrow from the other banks as well, but you don't want me to borrow from the other banks beyond a certain limit. Because if my company becomes bankrupt and you are the only bank, my lender, then all the assets, you have the first claim over it. But imagine I borrowed from Handelsbank and Danske also. Now the three banks will be sharing the same amount of assets to recover the money. So you will definitely be negatively affected. So what you do, how you ask me not to do this thing? You write a clause in the agreement when I approach you first time that, hey, we give you 80,000 loan euros. Okay, maybe depending upon my situation, you make assessment. Okay, you can borrow maximum 20,000 from the other banks. If you ever borrow more than 20,000 from the other bank, system is so centralized, we'll come to know, we'll catch you. Your loan can be cancelled. Okay, and all these things are mentioned where? In the agreement. And when all these clauses are put together and I know what to do, what not to do, then they are called debt covenants. Covenants means the clauses of what I can do or what I cannot do. See, these are the characteristics of our agreement. They're called debt covenants. So it means because of this debt covenant, I cannot just be shopping loans from wherever I want. It put restriction on me. And there's one more covenant. Nordea says that you can borrow from Danske, but in case your company become bankrupt, we would be the principal receiver of money. So we'll be the senior lender, Danske would be the junior lender. You see my point? So it means that if I become bankrupt, Nordea would take the money first from me, not Danske, because Danske comes in number 2 hierarchy. If I am left with something, only then Danske would get this money. But if you are the manager of Danske and you read the covenants that my first lender is Nordea and Danske is number 2, as a manager of Danske, would you be afraid of this situation? You will be. Then what will you do? You will charge higher rate of interest from me than what I'm paying to Nordea. So being a secondary lender, I have to compensate you for this juniority because you are a junior lender now. Okay, this is called interest premium. So I would pay more interest to Danske because Danske has less safety cushion in comparison to Nordea. So to cover up this risk, Danske may either decline loan to me or they would charge higher interest from me. And all these things are mentioned in agreement, what I can do or what I cannot do. And these are called covenants, debt covenants. Yeah, I think, what did I write? Yeah, leverage is written here. Yeah, that's fine. The third ratio is the gearing ratio. The gearing ratio says that the total, the current liabilities are not real a problem because the current liabilities are only for the short-term period. We are looking at the bigger picture, the long-term view. Therefore, and moreover, the current liabilities are more like operating. You know, you owe some money to a supplier. Okay, no problem. Tomorrow you have money, you will pay. No worries. But the long-term liabilities are the bigger problems. So they say that if you want to calculate the gearing ratio, then you can take away the current liabilities from total liabilities, and you divide it by the total capital employed. And the total capital employed is equal to total equity and the non-current debt. Okay? Non-current debt is the long-term debt. This gentleman event, we were discussing about his case company. His case company doesn't have a short-term debt, so they only have the non-current debt only. Okay, so these are some of the measures. There may be some more, but these three are the most important measures used in the to check the solvency. I would say this one is in research, in empirical research. We use this measure more often than the others because it shows both. It shows the nature of the resource, the source, the funding, the money comes in via debt and equity. So that is why this ratio is more often used in the empirical research. But as a corporate practitioners, you may use all types of ratios, no problem. And then we also have this financial leverage multiplier, which is total capital employed divided by the shareholders' equity. But the overall message is same, you know. Now for this, after discussing these solvency ratios, I want to have some brief discussion with you. When you look, not just the high or low financial leverage, but when you see that the company's liabilities or debt is increasing or is low, how do you decode this information? So when you see your company's debt to equity ratio is going up or total liabilities are going up, how you see this, how you perceive it, how you assess the situation? Is it a good thing or a bad thing? Of course, you can't be unaffected. When you see the debt to equity ratio is rising over time or is going down over time, how do you, what comment, how you interpret it? Because after all, when you write your report, you have to make an interpretation as well. Come on, it's a question to you. Yeah.
If the company or if the company is in the development area, maybe it's good idea to increase.
Yeah.
the company is in the risky situation, maybe like a large as people.
Yeah. Sam, yeah, thank you very much. This is very good explanation. Are you recording?
Yes.
Okay. I want to give you, it's not a part of any assignment. I want to give you a small homework today. Go through these red questions. Find out the answers to these in the context of your case company, so that when we come next week, before we go and discuss the investment ratios, we have some discussion about these points. And if possible, try to do the calculation of solvency ratios of your case company by that time as well, if possible. No, I'm not pushing you, but I just want to do the calculation if you can do. But about discussion part, you must be capable, you must be having enough of points to discuss these 5 questions when we meet next week. All right. So then we have one more session and we will complete this chapter, and then we discuss something else in the forthcoming weeks. And that's everything for today. Thank you so much. If you have any questions to me or Seher would stay a bit longer. If you have anything to ask, feel free. Thank you so much.